in investing, you get what you don't pay for. Costs matter. So intelligent investors should use low-cost index funds to build a diversified portfolio of stocks and bonds, and they will stay the course. And they won't be foolish enough to think that they can consistently outsmart the market.
Marie, how are we getting on?
I am well. I mean, this is the hottest day Ireland has had so far this year. So things are pretty good.
I was just about to ask. I'm like actually looking outside. Blue skies, scorching weather.
Yeah.
It's like 23, 24 degrees.
Yeah, it's very hot. And the room I'm sitting in, the heater is on. So
Yeah,
if I
obviously.
faint during this recording, that's what it's from. I don't want anybody to be concerned. I have a window open. So if you hear birds, that's what that is. It's just, we're covering all bases.
Yeah, we need hazard pay for podcasting.
Yeah.
I think this is the ultimate. This is the do you know how the boomers complain about the avocado toast generation? I think this is the ultimate avocado toast hazard pay for podcasting.
I mean, I think it's fair enough. I should be outside. I should have called in sick today. That's the truth of the matter. I should be sitting on the steps of my building in the sun, drinking a cold beverage.
Yeah. I always remember there's a stand-up bit where this guy was like, yeah, you know, sometimes I get depressed and then I go outside and then I'm not depressed. And then I kind of get depressed when I go inside. So I buy plants.
Yeah.
I open my windows. I set up my balcony. And then I'm thinking, maybe humans shouldn't live inside.
Yeah. And that's funny because I just read an article about vitamin D absorption that there's a big thing. They're always telling European people to take vitamin D supplements. We don't get enough sunlight. But apparently we don't absorb vitamin D out of supplements as well as we do out of the sun. But we're not supposed to go in the sun because we get really sunburnt. So they don't really tell us now.
Do you, sorry, I'm going off on 3 tangents before we even start the show, but do you follow your man, that Brian Johnson don't die guy?
No.
No? He's like obsessed with like longevity and like, health optimization. He looks like an alien.
Yes. Yeah. I did not know that was what his name was, but I have definitely seen him. I know of him.
Yes. So he obviously, I think whatever, the sun damage is the big thing for him.
Yeah.
And so he gets like no sun damage whatsoever.
Mm-hmm.
And he looks like a ghost from the Ebenezer Scrooge coming back to haunt his former self and stuff. It's horrible.
Yeah, he is pretty milky. I am also just wondering at this moment, is my microphone backwards? Do you have NT USB at the front of your microphone or at the back?
At the back.
Yep, perfect. Okay, 2 seconds.
Okay.
I think the audio will be usable. We'll find out.
Let's see if you're really scratchy for the start of this show.
Yeah. There we go. Any discernible difference?
Yeah, it actually improved.
Okay, all right, great. This is maybe my 100th episode of recording a podcast.
And you edited it as well.
Yeah.
Is there anything wrong with my sound?
Okay. All right.
I think we'll leave that in.
Yeah, fair enough. I think it's
people
fine.
Deserve to know. So what are we talking about today? We're talking about ETFs.
ETFs, yeah. It's probably the thing we get asked about the most. It is definitely like the most beginner-friendly topic because I think most people, when they think about, hey, I want to start investing, but I don't want to be too involved, they read about an ETF and then they're like, uh-oh, where do I go from here?
Yeah, 100%. And unfortunately, it's a bit of a tricky subject here in Ireland, but we'll plow on nonetheless because we've talked about this a bunch of times. We're hopefully going to see some more friendly regulation coming in budget 2026 when it comes to foreign ETFs, the taxation, getting rid of the deemed disposal law. That is not set in stone. People are quite confident it will happen, but we can never underestimate this government and its inability to become investor friendly.
Yep.
We've talked at length about it, but before we start talking about the kind of intricacies of ETF, I think it is important to give a little backstory of exactly what is an ETF. So it stands for Exchange Traded Fund, that essentially just holds a collection or a basket of assets. It doesn't have to be just stocks. There's bonds ETFs, there's commodities ETFs, there's Bitcoin ETF. It's become just the most common form of investment, really.
Yeah.
So what these basket of funds will do is aim to track a specific index, the performance of that index. The most common one is the S&P 500, collection of the 500 biggest public companies on the US stock market. But it doesn't have to be. It could be literally anything. And The key benefits, I suppose, to ETFs are diversification. You can own 500 stocks in one holding, and then lower costs. So most ETFs have relatively low management fees, especially passive ones that simply track an index.
Mm-hmm.
And this theme of low management fees is actually going to be prevalent throughout this episode because it's probably the most important aspect of ETFs. Essentially, ETFs came in to not replace mutual funds, but come as a competition to mutual funds. Mutual funds would aim to outperform certain indexes, always typically the S&P 500, but not
Yeah.
exactly. And for that outperformance, you would pay management fees on that. Now, an ETF coming in is saying we're not looking to outperform at all. We're just looking to track the indexes.
Mm-hmm.
And for that, we don't have to do any work. All we have to do is buy the composition of stocks, that basket of assets.
Yeah.
So it's very little work in terms of actual like management. It's a lot of logistics.
Mm-hmm.
And because of that, because they can do it at such a grand scale, it means they can charge very, very low management fees.
Yeah.
Now, what became prevalent is that ETFs actually started outperforming mutual funds, and active asset managers couldn't beat the index over prolonged periods of time. And so that's when the ETFs really make sense. So not only are you paying very little to no management fees, you're also outperforming a lot of these mutual funds as well. So it kind of came a no-brainer. And for how much of an entity it is now on public markets, and it's such a common investment vehicle, it's relatively new concept.
Yeah.
So they were first introduced in 1993. Very quiet debut. They only came into kind of popular, I suppose, the zeitgeist in around 2000. But even then, like, is in this concept of passive investing didn't really come to the fore until after the great financial crisis, I would say. And from there, the growth in these ETFs and passive investing and index funds and auto enrollment for your 401k or whatever else became so widespread. So in 2000, ETFs were about 1% of fund trading in the US. And nowadays it's between 26 and 30% of daily trading volume.
Mm-hmm.
So it just shows how far we've come here. And essentially, you know, it's the most accessible form of investing. Would you say that's correct?
Yeah, definitely. And it has like an outsized impact on the market. I was just reading an article about that last week where officials from JP Morgan were saying that so many individual investors just own like the S&P 500 ETF. It has a huge impact on when a company joins the S&P 500, they just move together in a school, even if, you know, an individual company is outperforming significantly. It's definitely been a massive innovation to the market.
100%. So let's talk about the logistics of it. So in terms of what is available to you
Yeah.
on your brokerage account, um, where would the first stop be for someone interested in ETFs, ETF
Yeah.
investing?
So for the context of this, I think it's probably beneficial if we like maybe talk through the lens of Revolut, simply because like we get a lot of questions in from Irish specific investors. And oftentimes if you're a complete newbie, like if you're in your first job or you only have 50 quid a month to put away, you might be like, hey, do you know what? I'm going to invest it through Revolut because I already have that account set up. And I think that's totally fine. The episode that we put out 2 weeks ago with Dave Quinn, who's a financial planner, he was kind of like, listen, for starting out, use Revolut. Like get into that habit of just putting something away. And then maybe when you get a bit more sophisticated, maybe then you look into a broker. So I went on Revolut and just had to look around. They have thousands of ETFs now at this point. As you were saying at the top, they're spread out by basically anything you'd want: country, holding, sector. They've got plenty of indice trackers, all kinds of things. So it can actually be kind of difficult to do the research of what ETF you want within Revolut itself. Researching stocks and researching ETFs to me is kind of like buying plane tickets, in that is a laptop activity. I can't do that on my phone. I can't see
Yeah.
anything. You can't compare anything properly. So for the sake of this episode, I use the website justetf.com, which makes really nice, great charts. You can compare the fees and the makeups and all that kind of stuff. So just for that context. So what I would say is before you head to your broker and start buying and selling ETFs, I would say sit down with yourself and say, okay, what type of ETF do you want? Want an S&P 500? Okay, cool. go to just ETF and look up, right, who are the providers of these S&P 500 funds, and then go on Revolut and be like, all right, I have a game plan. I know which one I want. I want a Vanguard, or I want a Fidelity, or whatever it may be. Obviously for this, like, we are ignoring that deemed disposal thing. We've been talking about it all year. Because that's also the main criticism we tend to get from Irish people. They're like, yeah, you can't just buy the S&P 500, but if deemed disposal is in play, it's going to ruin all your gains. But for right now, we are hoping and praying that goes away. So yeah, that would be my first idea off the top. Maybe don't go to your broker first. Do some exterior research, find out what's available to you on the market, and then go to your broker. To be fair to Revolut, if you do click into an ETF on the thing, they do like clearly have listed, here's your fee structure, here's the holding. You can look at the holding broken down by country and sector and all those kind of things. That's pretty good, but that's kind of the end of the information. And maybe you want to see a more detailed breakdown. You want to read, each ETF has to produce a prospectus, which is like a full PDF document. So, maybe that is worthwhile going and having a read of before you buy anything.
Yeah. And the important thing I would say as well is that there are so many ETF providers out there.
Yeah.
Don't overcomplicate things.
Yeah.
There are the four biggest ones. Well, there's the three big US ones. There's Vanguard, State Street, and BlackRock. And there's a bunch more. There's Fidelity. There's kind of all the major brokers will have one. Invesco for if you're going for more international bent, which a lot of, I suppose, European investors listening to this pod would be. Don't overcomplicate things. Just go with the most reliable, the biggest. They are the largest because they have been around for the longest. They've been doing it the longest. They're boring, I suppose, but you want boring. Yeah. This is not like the exciting part of investing. This isn't going stock picking and like looking for 100x returns and seeing kind of those, I suppose, life-changing investments. This is just a saving habit.
Yeah.
Instead of putting 50 quid, 100 quid, 500 quid, whatever you have at your disposal into your savings account, this will go straight into your brokerage account and will go into an ETF. And it's that passive investing where you don't have to worry about it. You don't even want to track the performance, really. Because if you're honestly going to be doing this for 30, 40 years, which is how long an investment horizon a lot of people will have, you want boring. And with the largest ETF providers, they're going to be the cheapest. So your basic for your S&P 500 or your global equity funds, don't stray away from the big guys, I would say.
Yeah.
If you're going into more specialist areas, make sure you do a lot of research on the ETF provider and their fee structure before investing. You could be eating away at your gains without realizing. Say if you're looking for like a niche, I don't know, cybersecurity ETF, or even if you're going down like the crypto route and you want a spot Bitcoin ETF, those fee structures are really going to start eating into your gains, especially if you're investing once a month for the next 10 years, 20 years, 30 years. So don't overcomplicate things is kind of the general gist I'm trying to say here. I've repeated it about 5 times. So hopefully this is kind of, you're absorbing it through osmosis. And then fee structure, look for the lowest management fees. And I think for Vanguard, they do 0.03% on their flagship S&P 500 ETF. So that's where I would go first.
Yeah.
Don't make it easy for yourself.
Yeah. It's also worth saying that the reason the largest providers can offer the lowest fees is because they have such an incredible volume of people owning that ETF that it allows them to offer cheaper and cheaper fees. So I think sometimes people are like, ooh, I'll go find a niche provider. But it's like the central point with ETFs is fee reduction. So just go, like, Vanguard is the largest offering. They kind of invented the technology. So it's like, okay, well, I understand why everybody is investing with this. Another good thing to talk about when trying to pick the specific ETF, as in picking out the ticker of the one you're going to buy. So you might say, okay, I want an S&P 500. Great. There are oftentimes 2 S&P 500 funds being provided by each provider, and they come in the form of an accumulating or distributing ETF. You'll often see it's in a parenthetical at the end. So it'll be like S&P 500, Vanguard, Global, Access, parentheses, distributing, or parentheses, accumulating. And what that means, it's in reference to the dividends. So we've gotten a couple of questions of this over the years, particularly from Irish people, because again, on Revolut and other common providers for Irish people, there's two Vanguard S&P 500 funds that you see. One is VUSA, VUSA, and one is VUA, VUAA. And VUSA is a distributing ETF, meaning your dividends are going to get paid out to you in the form of cash every quarter, whereas VUA is an accumulating ETF. So your dividends get automatically reinvested. And as you were kind of saying, if the goal here is to invest for the long term, if you're thinking 30 or 40 years, this is for retirement, VUA is by far the better option. Reinvested dividends actually make a huge impact over the long term, even though they don't look that, like, if unless you were a multi-millionaire and you had money sitting in the S&P 500, the dividend coming out of the S&P 500 is not going to be significant enough that it's going to make any impact on your life.
No.
It'll be
And
like,
this goes for individual stocks as well.
yeah, it's like, it's pennies on the dollar. It's even less than that. So don't be thinking this is lovely passive income. It'll be like £3 and you'll be like, oh, okay, well, I didn't need this. But a good example of this is if you invested $10,000 in the S&P 500 in 1960, which actually is not possible because, as you just said, the ETF was invented in 1993. But for the sake of this argument, if you invested in the S&P 500 in 1960 and held it until 2017 because you had a long and joyous life, if that fund had been a distributing ETF, you'd have $460,000. And if that fund was an accumulating ETF, you'd have $2.5 million. So
Wow.
5 times the amount of money simply by agreeing to reinvest your dividends. And that money
That's incredible.
means basically nothing to you anyway. So I would say make sure you're using an accumulating ETF. Don't bother with the distributing. The few quid you're going to get every quarter, it means nothing. Like, what are you going to do with £3 that you weren't expecting to get anyway? So I would say make sure, look for an accumulating ETF, and then you're good to go.
And this goes for any stocks you own as well that pay out a dividend.
Yeah.
Don't even think about it. And I know obviously they won't have that feature to accumulative, so you have to do it manually. But if you get a notification from your brokerage app and saying you got $2 from your Google shares, just go in and immediately put in a buy order. Now this might be awkward for some people, fees wise. We'd always recommend having commission free trading advice. I know Revolut only have one commission free trade a month. Is that correct? The next one will be €1, so it might be a bit awkward from that perspective, but always think of a dividend as, how would I say this? Don't worry about it for the next 30 years.
Yeah.
Do you know what I mean?
Yeah.
But if you're owning, say, Google shares and whatever they are in 30 years time, now that dividend could make a difference. Now that dividend is a nice little payout, 4 times a year. But now just put it back in and don't worry about it.
Yeah.
The only thing is it might cost you €1 to invest €1, which is not a good return. So
I mean,
think about your commission structure.
That is also a good argument for what broker you're choosing, because I know, again, because I'm investing through a US account with Fidelity, like I can turn that on where it's just automatic reinvestment for an individual stock holding. So it does it by itself. You don't even have to think about it. So yeah, that is probably it. As you can see, as you kind of progress up the advancement of investing here, it is worth looking at probably a broker provider that is a dedicated broker that is not just Revolut. That's I think we'll add some stuff in. Yeah.
Well, this is the thing you mentioned at the top of the episode. Revolut is probably the most accessible for a lot of people listening, but maybe you might level out of it eventually.
Yeah. And this then, I suppose, brings up the idea, we're talking a lot about the S&P 500. That tends to happen because everybody else is talking about the S&P 500. You hear it everywhere on social media and news and a lot of educational books. They always say, oh, just buy the S&P 500 and forget about it. But it is worth discussing the idea of maybe you want to look at other ETFs. Maybe you want a basket of ETFs, something like that. So then we need to talk about how, when you're doing your research on your ETFs, how are you picking what that fund is focusing on? And there's a lot of ways you can do this. As we said at the top, there's a lot of different types of ETFs. There's broad market, there's sector specific, there's ones that focus on market cap. So you could say, oh, I want small cap emerging market fund. There's geography, all kinds of stuff. So you picking out the fund is really going to depend on the type of investor that you are and what you're hoping to achieve with your ETFs. A basic rule of thumb, which you've said, is there tends to be more management fees the more niche the fund is, simply because there
Hmm.
tends to be less participation in it, and like more staff are employed to look after it. So, the S&P 500, a computer can basically run the S&P 500 index fund with a bit of oversight. If you're doing something really specific like cybersecurity, people have to sit down and debate the validity of this holding and this holding and this holding. And hey, Google has a cybersecurity wing, but it's a massive company. Like, how much of the portfolio should that make? That's a whole process which people need to get paid. So you will be paying more money for that. But of course, then you have to balance it out with the fact that, hey, it's a niche offering and it could significantly outperform the market for the next 10 or 15 years. So that's the kind of stuff you have to think about. One thing I will say, though, is that if you're starting out and the only thing you want as an investor is a couple of ETFs, as in you want to basically automate this process. You want to sit down, you want to learn about investing for 2 months. You want to say, cool, here's my 3 ETFs. I'm going to have money come out of my bank account automatically, go to my brokerage account and invest. And I don't want to think about this for another 3 years or 4 years, whatever. That kind of investing comes from a school called the Boglehead investing strategy. And
Is it Boggle or Bogle?
I've always said boggle, but it could be
Boggle, like
bogle.
Bogglehead.
Yeah,
That makes
Boglehead.
sense.
Yeah, that's what
I
I was
think it's
thinking.
I think it might be Bogle, but I'm not sure.
Well, he's
Bogle. It's tough
yeah,
to decipher.
boggle. Well, he's boggle today, I'll tell you what.
He's
Um
Boggle today.
So this is in reference to John Bogle. John Bogle was one of the founders of Vanguard, and he is widely regarded as the founding father of ETFs. He created the first index mutual fund back in 1975. As you were saying, these kind of didn't hit the market for most people until the early 2000s. That really, a lot of the credit for ETFs is because of computers, because we could automate so much of the work. But John Bogle set up an S&P 500 mutual fund, which had more fee structure in 1975. And everybody hated it at the time. They called it Bogle's Folly, because it went everyone was saying, oh, like, this is uncapitalistic. It's against efficient markets because you're just lumping all these stocks in together and allowing them to move and that kind of thing. I'm sure everybody who was critical of it was an active mutual fund manager, but it went on to be beloved by Warren Buffett, and Nobel Prize winning economist Paul Samuelson ranked this Bogle invention along with the invention of the wheel, the alphabet, and the Gutenberg press. So it was a pretty big deal when it showed up. But John Bogle wrote Common Sense Investing, which is a very famous beginner investing book. It's very popular. It's produced many a good quote, including "Don't look for the needle in the haystack, just buy the haystack." And under a Boglehead strategy, all you do is you buy a broad American market ETF, you buy a broad international market ETF, and you buy a bond fund. And that's it. You put money in
Yeah.
every month. You don't think about it. You keep fees low. You look for the lowest fee one you can find. You'll rotate more into bonds as you approach retirement, just so you less exposed to risk, and that cash is more freely available to you in case you need it. And yeah, his methodology is pretty much birthed a very passionate online community, which is known as the Bogleheads. They're very active on Reddit. All they do is debate which low-cost ETF is superior. And it really is the perfect solution for an investor who just wants to take a couple of weeks out of their life, set this all up, automate everything, and then just be like, okay, cool, I've done it. Investing is over. It's the cheapest, it's the easiest, the most hands-off solution. You need to do a bit of reading up at the top, but that's kind of it, really. Like, it probably is worth reading John's book, but I don't think you need to do anything more serious than that. Speaking of simple investing solutions, this is as good a time as any to remind you that this podcast is brought to you by Profit. Profit is MyWallSt's breakthrough investing solution. It has gone through more than 16 years of rigorous testing and has averaged a 21.6% annual return. That is just mind-blowing. And the absolute best part for you and me is that it takes just 5 minutes a month, no expertise required. Luckily for you, as it's just making its public debut, Stock Club listeners can take advantage of a 3-month free trial right now. So head to the website, useprofit.com. That's profit, Prophet, or just head down to our link below and use that. All right, let's get back to the podcast. But beyond a simple market fund, if you're more established investors, if you're looking at an ETF as a vehicle to introduce some level of diversification or balance, something we hear a lot from people is, oh, I'm really interested in this developing technology, but 1 or 2 major companies hasn't emerged yet as a front runner, so I don't know where to put my money. In that case, you can look for a more niche sector specific ETF. So an example of that is iShares has a robotics fund. Its ticker is RBOT. That should not be confused though with Vicarious Surgical, which has the same ticker but trades in New York. This iShares fund is in London. So if you want to look at it, just be careful. So say if you wanted exposure to robotics, but you didn't know what company you'd want to pick, you could look at RBOT and be like, oh yeah, cool. This is a great way to balance out my portfolio and get exposure to this area. That being said, as you said, it's more niche, so its expense is high. It's 0.4%, which is about 5 times the expense ratio that you would expect on a standard easy S&P 500 index fund.
No, no, about 10 times. No.
Well, it depends. See, with the Euro S&P 500s, typically the
Yes,
fee is
yes,
like
yes.
0.08. So it depends on who you're looking at and what currency and all that kind of stuff.
Yeah.
Yeah, but it's a niche fund. One thing I will say though, which comes up a lot with niche funds, you might be saying, hey, I love this emerging technology. I want a specific fund. Okay, yes, there is a expensive fee. Do you know what? It's fine because I want exposure to this. Make sure you hit the toggle and look at what is being held in that ETF, because more often than not, you'll be like, yes, emerging technology. Yay, yay, yay. And you open up that toggle of what's being held, and it'll be like Google, Apple, Amazon. And you're like,
Yeah.
okay,
Yeah.
well, how emerging is this? And then you're paying this huge fee to own basically the index anyway. So just make sure you're doing that kind of stuff if you're looking anything more niche and specific.
Absolutely. Yeah. And I was just thinking about this from last week. We did our quantum computing episode,
Yeah, yeah.
and there's all these exciting names of D Wave and IonQ and Rigetti and
Yeah.
the leaders, and the likely eventual winners are the most boring Amazon, Google, and Microsoft.
Yeah.
And it shows as well. I brought this up because we were talking about kind of how many ETFs should you own, and the answer is how long is a piece of string.
Yeah.
You nailed it there with the I think it's Bogle. Sorry, I was
This
googling it while you were.
is it
I was
Bogle?
googling it while you were talking. I'm not sure. I'm looking up here. It says BOWGL. This is
Yeah, it's
terrible
Bogle.
podcasting, but I'm actually gonna play. No, it didn't come up. I think it might be Bogle, but anyways, the strategy is just 3 ETFs and forget about it, and that goes into the thought process of really don't overcomplicate things for yourself. Make it
Yeah.
as simple as possible. But then, if you are a person, say, and you nail it there with the kind of not wanting to pick, like backing an industry over
Mm-hmm.
an individual winner. Quantum computing is a good example of, okay, well, yes, this is going to be big, but I don't have the balls to go and just put money into Rigetti computing right now. Like, as in
Yeah.
the timeline is so far away. But the beauty of, say, investing in an ETF like that is that will administer itself over the next 10, 15
Mm-hmm.
years. Okay, if Rigetti fails, essentially, which is a very real possibility, or IonQ or D-Wave or whoever else fails, that doesn't mean quantum computing isn't going to be the
No.
next big thing.
Yeah.
And so they'll find the next microcap in that space.
Mm-hmm.
They'll also invest probably very heavily in Amazon, Microsoft, and Google, because they're probably the most advanced when it comes to this technology too. Which is very, yeah, when you're looking at something so niche, and then you get essentially the leaders of the S&P 500 at the top of the holdings, it does get a bit disappointing, but that's probably just a reality of any kind of tech investing right now. The most advanced
Yeah.
companies are also the biggest market leaders, and these hyperscalers, which we can't go one episode without talking about because they're so dominant in the market.
Yeah.
But yeah, you really can do whatever you want when it comes to how many ETFs to own, but
Mm-hmm.
I wouldn't go for too many. I would
Yeah.
keep it, at 6, 7 max.
Yeah.
And that's if you really want to get into the thematic investing side of things, or international diversification, or specific regions.
Mm-hmm.
So yeah. It's we're, I suppose, it's imploring a bit of a kind of Boglehead attitude of just make it as simple as possible. And
Yeah.
because those ETFs are going to be the least, you're going to be paying the least management fees as well, which is important too.
Yeah. It's also worth saying ETFs tend to overlap a significant amount. Like even if we were to take Bogle strategy and say, okay, I just want an American market and I want an international market fund. Because the international market has come to dominate finance since 2008, even if you own an international market fund,
Oh yeah, the
America,
U.S. market. Sorry.
yeah,
Yeah, yeah,
the
yeah.
the U.S. market still ends up making up like 50 or 60% of the international ETF
Yes,
if it's a
because
total global fund.
I think since 2008, it's gone from like one third of the global
Hmm.
uh, public company market cap to two thirds.
Yeah. So then you
Yeah.
effectively, even though in your head you're like, I'm de-risking America by owning international, 2/3 of the international quote unquote fund is American. So,
Yes.
you maybe need to, again, it's good to have a dig in and look at the holdings because then you can maybe say, oh, because there are
Maybe
definitely ETFs that are
maybe you could just
non-American.
hold a maybe you just hold an international.
Yeah. Yeah. But it's a thing of like international, if that's labeled, brokerages are often including American stocks in it. So it's just, again, the thing of like, just look at the country
But
breakdown.
that's what I mean in the sense of we talk so much about the S&P 500 ETF,
Oh, yeah.
and
Just hold a
at,
global
at
index.
its most basic, that is the go-to.
Yeah.
If you're a European investor, maybe you forego that, which sounds a bit sacrilegious, but
Yeah.
you're already owning about 60% of your international ETF is going to be that in some shape or form.
Yeah. Yeah. And
Yeah.
particularly, I know right now people are kind of like, oh, we're getting a lot of messages of people who are trying to counterbalance American investments with European ones just because they're a bit nervous about the tariff situation. And yeah, if you're owning a global index, it's like, well, you know, if money's rotating out of one region and going to the next doesn't really matter because I own them both. So it's like, okay.
Yeah.
Yeah. All right. And then finally, maybe not finally, but most importantly, we got to talk about fees, as we have mentioned fees in absolutely every single part of this conversation so
Yeah.
far. But just a kind of an in-depth look at them. Um, Again, to go back to the Bogleheads, I cannot believe it is Bogle. But anyway, he has another great quote: "In investing, you get what you don't pay for. Costs matter. So intelligent investors should use low-cost index funds to build a diversified portfolio of stocks and bonds, and they will stay the course. And they won't be foolish enough to think that they can consistently outsmart the market." And a great example of this was I recently was having a look at an ETF that is dedicated to the Nordics, specifically Sweden. It's like more than 50% of the stocks are held in Sweden. It's run by Fidelity. It's the Fidelity Nordic Fund. Its ticker is FNORX. Amundi has a somewhat similar product in Revolut, but it's not as well diversified across that region. I was very interested in this because, as we've been harping on for the last 2 years, Sweden is a really, really interesting place to invest at the minute because they have a really wonderful infrastructure set up for everyday investors to take advantage of tax and participate. And they're really encouraged to invest in local Swedish companies. So we're seeing a lot of innovation come out of there. And, Emmet has pitched a number of stocks for Horizon and Nexus that are Swedish born. And I was like, do you know what? I don't want to pick a Swedish specific stock. There's got to be a fund. Found the fund. Great. The bummer is its fee is 0.87%, which is pretty
Point
high.
0.8.
Yeah.
Wow. That's incredibly high. That's double any kind of
Hmm.
thematic one I've been coming across.
Yeah.
That's double the quantum computing
I know.
ETF, which
Very
I thought
high.
would be pretty expensive. Yeah.
Yeah, and I'm assuming some of that that's wrapped up in there is currency stuff because
Yeah.
obviously they're focusing on four main countries, so they all four of those countries are running on different currencies. So then they have to correct for the currency stuff and the active management, and it's probably an expense of them trying to buy the European companies because it's a USD American based fund. There's probably a bunch of stuff in there, plus the management fee and all that kind of stuff. So but I was looking at this fund because for the last 10 years, it's done almost 10% annual return, which is pretty solid for a non-market index. So I was like, it could still be worth a bite. But then you can go on Stablebread, which is just an investing research platform, and they have an expense ratio impact calculator, which allows you to see how big of a chunk those fees are going to take out of a long-term holding. And so I went ahead and said, okay, if I put $10,000 into this right now and I held it for 40 years, assuming a 10% annual return, which is of course generous because past performance does not indicate future performance, but for the sake of this, and then I put in the 0.87% fee. So at the end of that 40 years, I would walk away with $330,000, but I would have lost $120,000 to fees.
Okay. So
So
more than a quarter.
yeah. And it
Wow.
stings. That would, yeah, it would definitely sting. And then so you can then sit and say, okay, do you know what? Maybe just go, if you go for just a broad European stock index fund, you can get one of those for 0.08% expense ratio. That's
Hmm.
dirt cheap. And so, yes, the broad European index fund is not doing 10% a year. It's averaging about 6% a year. But if you put 100, you put 10,000 in, you'll make about 100,000 and you only lose 3,000 to fees. So it is that thing of like, you need to balance stuff out. You will make less money, but you will have lost less to fees. So, you kind of have to do that
Well,
thing.
I think it's a perfect example of just how much fees make an impact on
Oh yeah.
long-term returns,
Yeah.
and to show how important it is to make sure you're accessing the lowest fee ETFs possible
Hmm.
at your disposal, and that will depend on where you're living and all the rest. But yeah, it goes to show just how impactful they are.
Yeah. They can take a big bite. And so that means in an absolutely perfect world, you will be paying a high fee because you are going to get outstanding long-term outperformance. But it's not guaranteed. And as we know, everybody has seen that chart of like every time the American stock market begins to underperform, the European outperforms, and they kind of rotate back and forth and back and forth. And so we can't even comfortably sit here and say, hey, you know, Europe has underperformed the last 10 or 15 years. So rotate into Europe, because if you're going to hold for 40, you could go through 2 or 3 of these rotational cycles. So it's just, you know, going low fee, broad index, you just don't have to think about so much stuff.
Just we keep saying the same. We keep circling back to the same points
Yeah.
of don't overcomplicate it
Yeah.
and find low fees, and that's
Exactly.
pretty much it. And
Yeah.
this last point I'm going to make is a question we get a lot, and probably makes a big difference in the short term. But you were talking about if you're going to hold these holdings for 30 or 40 years, it'll
Yeah.
flip flop so much back and forth that eventually it's not really worth spending a lot of time on, and that's investing in your home currency or USD, which a lot of these ETFs will be held in.
Yeah.
And obviously, it's very topical right now because we have a falling dollar.
Hmm.
So a lot of international investors in US stocks have been hit with a double whammy where US stocks are falling, but on top of that, the dollar has weakened significantly against the euro and the pound as well, meaning that if you're holding US stocks in dollars, which the vast majority of people will be, then they'd be worth proportionally less on top of them already going down.
Yeah.
Do you get what I mean? So it's like that, it's a 1-2 punch. And I guess people only notice it when it's affecting them negatively.
Hmm.
However, like coming out of COVID, the dollar hammered the euro for years while US stocks outperformed as well. So you're getting the double whammy the other way. And it's very indicative of like investing in general and the kind of the psychological fallacies we all fall into where you only notice the negative and you don't notice the
Yeah.
positive. So a lot of this episode revolves around avoiding fees. If you're investing every month and having to also pay a currency exchange fee, that's going to add up.
Yep.
If you can invest in dollars with no extra fee, I would say just choose that option.
Yeah.
If you're going to get charged every time, don't, because US ETFs that operate in euro will have higher fees than the basic Vanguard ETFs. But look, it's just going back. I'm just repeating myself now, but just don't overcomplicate it. It's
Yeah.
going to be much of a muchness when it comes to foreign sea exchange fluctuations in the long run,
Yeah.
because you could be holding these positions for 20, 30 years.
Yeah.
We're going to see so much back and forth between strong euro, strong dollar, whatever else.
Yeah.
I'm not going to get into a conversation about the dollar losing its reserve status, which seems to pop up a lot, but is very prevalent right now because of just the whole everything that is going on.
Hmm.
And frankly, I'm unqualified to talk about it. Like, this is going into real like geopolitics and everything else. But if that does happen, foreign exchange costs are going to be the least of your worries when it comes to the US stocks you own. So
Yeah.
from that perspective, I think, look, this is going to be a boring episode, but don't overcomplicate it. Try to avoid fees as much as possible, and however which way that works for you,
Yeah.
do that.
Yeah.
Don't stress about currency exchanges if you're going to be investing for 30 or 40 years.
Yeah, particularly if you're doing it monthly, it can be kind of a headache to try, because then every month you're being exposed to the currency fluctuations. Every month you're saying, okay, I got to move my 100 euro into dollars and then invest that into the S&P 500. Whereas you can buy the S&P 500 in euros through a European broker. And yes, the fee is marginally higher. I think it's like USD, it's 0.03% for the S&P 500. In euro, it's 0.08% because they're absorbing that currency
Yeah.
hit. And again, like if you're doing a 50 or 100 a month, and this is a starting thing, I would just say it's just you do the easier, just invest in the
Yeah.
euro, and then
I think that is just the exact advice. Do
yeah,
what's easiest
yeah.
every time.
And then, maybe we'll get to a point, fingers crossed, in your career where you're going, hey, I actually have a huge chunk of money I want to invest. Then it's worthwhile go to an investment advisor and talk it through and be like, yeah, actually put this in dollars and then do what you
Yeah.
want. Yeah. Yeah.
I guess the general advice of this is going to be, a lot of people are listening to this, maybe investing for the first time,
Yeah.
and they have these mental roadblocks and kind of, I want to make sure I'm doing it the right way and all the rest.
Mm.
For right now, the most important thing is to get started and to make it as easy as possible for
Yeah.
yourself to build this habit and do it month after month after month.
Mm-hmm.
And then down the line, yeah, okay, we can get into the intricacies of it. But
Mm-hmm.
over the long term, the most important thing is to build that habit. And from there,
Yeah.
you can worry about all the rest.
Because time really is, it's more valuable in the investing landscape. Time is more valuable than anything else because it just opens up compounding so much. Like, you see that stat all the time where it's like Warren Buffett built the vast majority of his wealth after he
Mm,
turned 80 because he was
yeah.
holding so much stuff for so long. And so you kind of need to set that up for yourself. You need to be in your 20s and 30s and going, okay, I'm putting this is 50 quid. And maybe 50 quid doesn't seem like a lot, but you have so much time to compound, it will become a lot. So if all you want your investing career to be is putting money in like 2 or 3 ETFs, that's totally fine. Like, I don't think, I don't think sometimes people engage with a lot of investing media content and they're like, wow, I need to do ETFs and then I need to do individual stocks and then I need to do crypto. And that, they're kind of setting up all these stages for themselves. But you can just be like ETFs and I'm done. I'll see you in
Yeah.
4 decades. Cool. That is
Yeah.
totally
Like
acceptable.
we love individual stock investing here. We've seen the benefits of it, but we also accept that it is a niche. It's not for
Oh,
everyone.
yeah.
And like the time investment and the interest, you have to
Mm,
be interested and enjoy it to really do it like long term and successfully.
mm,
And some people don't have that graw for it. Like, so if that's you, but you're also feeling like, okay, I need to do something here, I need to get off my ass and start
yeah.
doing it, well, this is the most passive and easiest method for you. And maybe this will like pique that interest in the stock market, and from there you'll be like, okay, that's my investing habit. I do that at the start of the month. When I get paid, I put in X, Y, and
Yeah.
Z into X, Y, and Z and whatever else. But also, I'm following enough news and
Mm,
research and newsletters and my Wall Street podcast and content, obviously, to know, okay, maybe Amazon is a great buy right now because of this tariff impact and it's not going to stay around forever. Or, wow, there's this stock that I know from, say, my career, that this company is red hot and it's a
yeah.
public company and I can invest in it and I have this inside track. So it could be the stepping stone to becoming an individual stock investor as well.
Yeah.
And honestly, like that's where the fun is.
Yeah.
Like this passive investing isn't fun, but it's an unbelievable benefit, and it's the simplest way of doing it. But
Mm,
then you can add excitement into it on top of that,
yeah.
if that makes sense. So yeah,
Yeah. I would also say owning, like having a cushion and a starting place of, oh yeah, I already have money in a broad market ETF or in 2 or 3 of them. It does make buying individual stocks easier in a sense because you can say, well, I have a lot of money that is invested passively and I'm not where, it's over there, it's doing its thing. I don't think about that. I don't have to manage it. And that does, I think, sometimes allow you to go like, okay, I want 10% of my portfolio or 15 or 20% of my portfolio to be individual stocks because you just feel like, okay, I've done the diversification bit. That's done. I
yeah,
have this stable foundation I'm going to try and build upon. Um, yeah, it really is just like the perfect first step.
yeah,
Oh,
absolutely.
this actually raises a very good question, which is if you could only buy one ETF for the rest of your investing career, what ETF would it be?
uh a broad market, an S&P 500 ETF, not worry about it. The US market has been the most successful. There is talks of international outperformance and European outperformance and all the rest,
Mm-hmm.
but I think it's the simplest thing. Don't worry about it. S&P 500 and make sure it's as low as management fee as possible. That would be, I don't know, VU or SPY or VUSA or
Yeah.
any of those, whichever is the easiest for you and your brokerage setup at the time.
Yeah.
Yeah.
Least
Would you be?
least innovative advice. Yes.
I know it's the most basic thing ever, but I think this whole episode is the most basic thing ever.
Yeah,
Would you?
no,
What would yours be?
I think I would agree. The S&P 500. I
Yeah.
mean, yes, there's over concerns of like, oh, America is leads too much of the global index. There's, it is that thing of like in your head, you're almost like, surely this is inevitable. Surely this market cannot continue to grow leaps and bounds ahead of other international indexes. But so much technology resides in the
That's the
United
thing.
States and trades on the American Stock Exchange. Even
Yeah.
technology, it's worth saying, a lot of technology companies that do not exist in America, as in none of their business is in the United States. They trade on the American Stock Exchange because they wanted access to the capital, like something like Mercado Libre or C Limited. And so you are still getting international exposure if you're holding a broad market American fund, because not all the companies are American. Um, yeah, I just think the S&P 500, it's just, you don't even have to think about it. It's what everybody says. It's what Warren Buffett says. Warren Buffett says, he basically is like, if you have less than $100 million, you should put it in a low cost ETF, and that should be it. Good night. Like,
Yeah.
yeah,
And you're so right about the technology aspect as well. Like, as in America has clearly established itself as the home of tech companies, and
yeah,
we've seen the rise of the $1 trillion company in the space of the last 10 years, and they've all been in the US.
mm-hmm.
Europe hasn't got close. I know there's Aramco, um,
Yeah,
but apart from that, uh, no other company has got really anywhere near that $1 trillion mark. And they're all tech companies, and they're all based not in or around Silicon Valley, but like that tech hub and that innovation,
yeah,
the capital for private investing, it's all there, and it all comes from America. And that's a big reason why it's grown so much. Say, we talked about 2008 and how much of an influence the US has taken over the global stock market as a whole. So much of it is because of that.
yeah,
So yeah, that's more reason why you would go for an S&P 500.
yeah,
But you're not going to be wrong if you go for a global ETF either. Like,
yeah. It just, it just means that you're not going to, you often hear people are like, oh, a benchmark of a great investment is beating the market. And oftentimes when they say that, they're referencing the S&P 500. But if if you hold a global fund, you're not going to beat the market. You're not going to beat the S&P 500, but you are de-risking, which is, I know, like if you're a young person, you're like, I want the greatest returns possible. But if you are older and you're maybe closer to retirement age, it is of benefit for you to lessen returns in favor of de-risking your portfolio in case you need access to the money. Um, but it's to each their own. Like, just look at your own appetite for risk, your own appetite for, maybe holding a one geography index. Yeah, and just again, low cost, low cost, low cost. Do not lose a bunch
yeah,
of money to fees that you don't have to.
exactly. Okay, we're going to finish up there. That was a good episode. I think it's funny. I always feel like, geez, I keep saying the same thing over the course of an episode, but in hindsight, it's probably a good thing.
Yeah,
Do you know what I mean? If
yeah,
there is like one theme of, okay, keep it simple, low fees, and whatever habit you can build is going to be the one that lasts.
yeah,
And I think there's almost a moral of the episode. Um, so for next week, we've said what we're going to do is pick out a few individual stocks um, that act in a similar way to index investing. So these are like incredibly diversified conglomerates that might hold hundreds of businesses under one name.
mm-hmm.
And in turn, you're kind of investing in one stock, but getting the diversification of an index.
Yeah,
So it's something I've been looking into, particularly from an Irish perspective, because our ETF investing landscape is so poor tax wise.
yeah,
And so I've tried to identify a bunch of companies that have the similar levels of diversification as an ETF in some shape or form. They'll obviously be a bit more like thematically focused,
yeah,
but not always.
yeah,
There's one stock in particular that is the most diversified business I've ever seen across geographies, across sectors, across everything else. So
mm-hmm.
we're teasing that for next week. It's a particularly good episode to listen to if you are an Irish investor. So I would highly recommend tuning in next week. And yeah, it's going to be me and you again, Emery.
yeah.
And then I think Emmett Emmett is doing one of his solo specials, so
Yeah.
that'll always be interesting.
He
The
already,
inside the ramblings of a madman.
yeah, he's already prepped his short story for you, so everybody be excited. We'll maybe do some audio engineering, get a bit of some background music going or something like that. Yeah.
Okay, perfect. Amory, thank you for joining me, and thanks everyone for listening in. And we'll talk to you next week. And especially if you're an Irish investor listening to this, make sure you tune in next week because there'll be some great stock pitches there that will suit the situation we're in very well. Okay, so we'll take it easy.